We just showed the audience just a second ago the forecast for March retail sales, very slight pullback, about 0.5%. Is that a meaningful report in this current environment when we have so many other things going on, including big bank earnings coming up later today? What can this tell us about the economy and possibly about the markets?
I think there is some meaning in the retail sales report that's coming out later today, and I think it is likely to show a pullback. And I think we're going to get used to economic data continue to slow into the next couple of quarters, particularly in the second half of the year, where we also see quarterly growth profile going slightly negative. So I do think it's meaningful, and hopefully it's going to bring down inflation continuously, as we've seen both with headline PPI and CPI over the last couple of days as well.
All right, so the big focus today is those big bank earnings. The Fed, they voiced it very clearly. They have a lot of concerns about the impact of the banking crisis on the broader economy, forecasting a mild recession because of it. What are you looking for in these upcoming reports?
So we're definitely looking at loan provisions as one kind of measure in terms of how worried the banks are in terms of this upcoming slowdown in economic activity and the amount of defaults they might be seeing both on some of the consumers, some of the companies that they're lending to. I'm particularly interested to see as well whether on the earnings front, kind of the increase in interest rate is likely to bring some of this net interest margins higher, and to which extent at some point we can start to be maybe a bit more positive on banks. So here at UBS, we've been a bit more negative on US banks, more neutral on the European ones, but we're also starting to see that there's a lot of value creeping into some of these markets. So European banks, as an example, trading at 6-7 times earnings, we're likely to see, as long as the economy is holding up in places like Europe, there could be maybe even a bit of an opportunity.
All right, so talk just a little bit about portfolio management right now. Obviously, you're managing the wealth of high net worth individuals right now. How are you positioning ahead of this next Fed meeting? You mentioned a possible increase in interest rates, maybe even another rate hike. And how do you see the big banks weighing on that possible rate hike compared to PCE, which is coming up at the end of April?
So it feels like a difficult time to be advising private wealth, because on one hand side, we have a slowing economic activity, in particular in the US, that is likely to drag stocks a bit further down. We have the S&P at 3,800 at the end of this year, so not a lot of upside here. On the other hand side, as long as the Fed keeps hiking, there are some worries about if interest rates continue to move higher. We do actually think that high quality bonds, in particular in the investment grade area, has a lot of value with yields of around 5-6%. So with an expected slowdown in both growth and inflation, we actually tend to tilt our portfolios a bit more defensive, a bit more towards this kind of higher rated bond segment at this point in time.
Really interesting.